Ladies and gentlemen, welcome to our property and finance podcast here at Shaw Financial. Today we have a very special guest, a repeat guest, returning back from maybe about a year ago, I think it was our last episode.
Yeah.
Josh Phegan, the international real estate rock star, you could say.
Geez, you talked that up.
Yeah. Josh is a real estate coach across all major cities of Australia, all the major brands in each city he coaches and trains on a group and individual level. On top of that, he's international, training real estate groups in New Zealand, Dubai, and the UK, I believe.
Yeah, that's right. Yeah.
So he's got a great sort of exposure to the forefront, you could say, of real estate, the front line. On our end, it's been a while since we had a podcast as well. It's been a couple of months. We had a bit of a break, and a lot has happened in those couple months. A lot's happened also since Josh was last on our podcast. So we should recap. Let's do a bit of a finance update, I should say, first on what's happened in the last couple of months. So the big one was the US Fed. I'd start with that, cutting rates. It was a bigger cut than expected. It was 50 points as opposed to 25. The market had priced in 25. Everybody was expecting 25 basis points. And a 50-point cut is normally reserved for sort of, GFC type situations or COVID, So whilst it's relieving, it's, some would say, alarming as well.
And New Zealand's 0.75, right?
Yeah. Yeah, but I feel all eyes were on the US a bit more.
Yeah.
It didn't interrupt markets too much, the share markets I'm talking about now. Equities are at all-time highs. We keep breaking new records globally, or mainly in the US and locally in equities. It's surprising to see because there is some underlying concern in businesses and whatnot. Obviously, there's a bit of a cost of businesses have gone through the roof, and there's some fundamental issues, but the share markets are strong. Real estate on the other side is different. It's a bit patchy. We're seeing interest rates have been at this peak level now. Geez, when was it? Almost a year ago we had the last rate rise. So households are feeling the brunt for a while. If we talk about the fundamental data coming out of Australia, unemployment has been up and down. Inflation, whilst it came down, has also been up and down. So the most recent data of inflation was the monthly data being 2.7%. The most recent quarter being the more crucial piece of data to follow, because it's a bit more comprehensive than the monthly. The quarterly indicator of inflation actually increased, which was concerning. That made people think no more rate rises, no more rate cuts anytime soon. So all eyes are on the next quarter of inflation data that will be released on the 30th of October. That's basically going to dictate what's going to happen this year with interest rates. I don't think, unfortunately, guys, we're going to see a rate cut anytime soon, just because I think that even if that data is showing a decrease in inflation, it's going to be at 3% or below for them to justify a rate cut. The most recent unemployment data at 4.1 is showing that the economy is still strong, and that puts upward pressure on wages, which is inflationary in itself. So lots going on, but let's talk about your world, Josh. Let's get some of that experience with your flying all over the country and seeing what real estate businesses are feeling. What's the general consensus out there?
So, Theo, we've got like triple speed markets, and this is one of the most amazing things to go and have a look at. That we've got things that go to influence the property market, and the big one, for example, is about what's actually happening in Victoria. Now, don't forget that Melbourne is nearly the largest city in Australia. It's just about to eclipse Sydney in terms of population growth, but yet it's probably one of the, if not the weakest market in all of Australia. And there's a lot of reasons for that, and there's lots of taxes that are associated there. There's a second property tax or investor tax for a 10-year COVID levy, which is an increase in the land tax in that environment, which is forcing lots of people to have to sell. And if you go to some of the more desirable lifestyle type markets like Daylesford, Geelong Surf Coast, Mornington Peninsula, it's literally spot the house without the for sale sign. And it's a dire conversation compared to what's actually happening here in New South Wales.
Or other parts of Australia, right?
Yeah. So what a lot of people don't realise is that you've still got Adelaide booming, you've still got Brisbane in denial, and you've got the Gold Coast still going quite well. And a lot of those markets are actually seeing a ton of investors that are actually taking their money out of Victoria and they're putting it into those states that don't have that prohibitive investment tax. Now, what that's seeing is, I think, it was like 38% of all loans last month from the data that I'd read were coming with investors. So there's lots of investment activity. And this is the interesting conversation. It's just not in Victoria. And so Victoria's got a record amount of taxes. It's got the slowest amount of growth. It's in the position that ultimately it's got the highest number of hospitality closures of any state in Australia. So when you start to have a look there, that's really running differently.
And you got to sort of go in there cautiously if you are thinking, well, hang on, well, maybe if Melbourne is having a bit of a downward pressure on prices, is now the time to potentially buy. But the problem is it could probably go backwards for a few more years before it starts going up, right?
I would say that literally outside of the government making a change on that tax, you could say that Melbourne is going to be like it is for the course of the next decade. And that's how negative that actually is in terms of from a consumer point of view. So let's say, and it's not quite, but this is a great way to think about it. Let's say that your grandfather had come out to Australia and had done really well. And over time, they'd bought a weekender somewhere. And naturally, as a family, you've gone to go and use that. Now, 1, 2, 3 generations later, you're going there for Christmas, you're doing all of those things. Now, all of a sudden, that land holding might be worth, say, $5 million. It's like, and it's not quite this number, but it's a nice way to kind of think about it. It's like you've got to go and write out a check for $200,000 to $250,000 in extra land tax every year now over the course of the next 10 years.
So let's highlight those taxes firstly. It's not just land tax. So
Airbnb tax.
There's most of the taxes are focused on investors, but there's also just stamp duty that is applicable to owner-occupiers. So there's been an increase in stamp duty, there's been an increase in land tax, there's been Airbnb tax on gross revenue of your rental income, which is the highest Airbnb tax globally.
Sure.
Am I missing any? I think
then on top of that, they've got things like rent caps, where there's there's a restriction on when you can put up rent, how much you can put rent up by. Then there's a conversation around saying, you know what, we actually want safer properties, which is fine, but there's gas compliance, electricity compliance, like a whole range of compliance mechanisms. And so literally it just doesn't stack up. So, and then when you go and have a look in the commercial world, I was doing work with a client down there recently. They've got 170 properties available in their commercial portfolio to sell. And I said to them, okay, how many of them are you selling with development potential? They said 70. I said, well, forget those. That leaves us with 100. How many are being put through at a cap rate of less than 4%? Oh, that'll be 80. Okay, great, we'll forget those. So there's actually 20 that are actually priced correctly. So we're actually in the new era of repricing, and there's a global repricing of assets.
So let's just highlight a few things. What I don't understand, it's crazy what's happened down there because... For the last decade as well, apartments in particular, I think for the last 10 years it was about a 1.5% annual growth on apartments. So they've made it more difficult for developers to get stock out of the ground because let's face it, a lot of these brand new units are for investors. So I believe supplies decreased quite a lot in the brand new space.
Absolutely.
A lot of them shifted toward these house and land packages, but that I believe is easing in supply as well.
Sure, but so someone said to me the other day, like the cost of a block of land has not fundamentally changed that much in Victoria. It's just if you have a look at over the last 10 years, they've gone from 800 to 300 square metres. So it's still the same amount of money, but literally the size of the block has substantially decreased. And what that's done is it's forced a lot of developers to actually shift the size of an apartment. So now all of a sudden, a one-bedroom apartment might have been 60, 70, 75 square metres. And now they're trying to get some of these things away at like 35 square metres.
Yeah.
And lenders don't overly love that style of asset in terms of level of risk profile. And so this is the challenge, is that ultimately there are really some big systemic issues ahead. A lot of it has got to come down. The cost of capital is too high compared to the returns that we're actually generating. And I read a ridiculous report the other day, and it was something crazy where they're saying that, if every extra $10 in interest expense, it was like only 3 cents that the landlord was able to recoup through rental increases. So there's been a substantial out of whack increase in how much it's costing me to go and service the loan versus the rent that's actually coming through. And so ultimately, people are turning to alternative asset classes.
Alternative markets. Yeah. So it's crazy. Those things have just been introduced as well, right? So it's not going to change anytime soon.
Sure. So outside of so put it this way, if the government in Victoria came out and said, you know what, we got this land tax thing wrong on the 10-year COVID levy, we're just going to repeal it, my gut feel is about 30 to 40% of listings in Victoria would withdraw overnight.
Yeah, wow.
So when you go into markets, and Louis Christopher's got some exceptional reporting on this on his SQM website, but one of the key things that literally you're going to look at in places like Daylesford, close to 85% of the listings have been on for more than 6 months. So more than 6 months is a long period of time. Like a healthy market is probably sub 30 days in terms of selling. 6 months on the market tells me that literally it's a lot of properties that are stuck there, and everyone wants to get out before circa the 30th of December because whoever owns the property on that date is the one who gets the land tax bill.
Well, speaking of taxes and implications on the property market with governments getting taxes sometimes wrong, there's been a few changes in the super space that, whilst I think they said it only affected about 9% of people with a self-managed super fund, or 9% of Australians, I should say.
Sure.
With that 3 mil threshold. There's a crazy one I can't believe it's sort of not being made aware enough in my eyes to the average Australian. So firstly, the $3 million threshold on that superannuation balance, it's not indexed, so it's not going to increase. But more importantly, if you own a property in your super and you've got over $3 million in super, you've got to start paying tax on unrealised gains.
Mm-hmm.
Unrealised capital gains. So you have to crystallise a profit somehow and something else, potentially even sell a property to pay the tax. It's pretty ridiculous. Apparently that's been actually passed and it's being argued. It's not something that's being put forward and debated. It's actually in place. The other policies that I think need to be watched carefully, the one that keeps coming up at every election, it's like a political football, is the negative gearing and capital gains tax discounts. What's your thoughts this coming election? Is it going to resurface? It just surfaced recently.
So my gut feels that this is the same playbook of what actually happened in the last election. So what you do is you scare the hell out of the electorate and then you drop the policy just before you go to market. And like Albanese would, if he's reading the play right about what's actually happened, is that Shorten clearly didn't get in around negative gearing. And if you make a change around negative gearing, there's a lot of Australians that will say, hey. Now what it actually does in terms of the property market though is that people say, if I'm uncertain about what the policy is, because like literally then I'm just not going to invest. So I actually see a hiatus that for now over the course of the next 4 or 5 months as we head into an election period, that there's just going to be a real slowdown in investor activity to say,
which is what we don't need right now.
And this is that whole thing is that like we didn't order it, we're not sure, but somehow Treasury's done it, but we're going to read it, but we're not sure whether or not we're going to commit to it, and we wouldn't want to touch it, but we might have a quick look at it just on the off chance in case that maybe we might need to do a negotiation with the Greens to get in as a minority government. So what you've got to realise very quickly is that literally Australia is actually devoid of high-quality policy when it comes to what we're doing in the property sector. The sooner the government gets out of trying to provide accommodation, the better. It is a free market enterprise that does need to provide a lot of the solutions here. And the reality of it is that we've got some really substantial challenges ahead. Now, if you go and have a look about what's actually happening in the economy, and I have a look at my Shore financial tables that help me on this, and legitimately you've been providing some incredible tools and resources for agents, is that what you've got to realise, okay, Brett, let's go and have a chat about if they make changes around negative gearing, why is there a record amount of negative gearing that the government's currently paying out today? Because interest rates are higher. So because interest rates are higher, we're now paying out, in inverted commas, large amounts of benefits for investors that have bought properties. Now, these investors are in a position that all of a sudden they're being told how much they can rent the property for. And so then I've got a home loan or a mortgage on the property up here, but I'm being told I can't increase it. So therefore you're having to pay out record amounts. So we're just not going to pay that anymore. At what point before the investor just gets out? And so this is actually where policy's problem.
But this is exactly how it could happen. A policy like getting rid of negative gearing or abolishing a discount on capital gains tax.
Yeah.
So just for those of you that don't know, because I feel like, I'd say 98% of the consumers in our database who are sophisticated and, sometimes have 1 or 2 investment properties as well, they don't actually, not everybody is quite across what the discount on capital gains tax is and what I'm even referring to. So technically capital gains tax is actually your income tax. So whatever bracket you're in, that's what your capital gains tax is. You would assume that the year you crystallise and recognise a capital gain on a sale of an investment property, it'll push you into that top tax bracket anyway. So technically it's 48 cents to the dollar.
Yeah.
However, you get a discount if you've held the asset for more than 12 months.
Yeah.
That asset could be property, could be shares, could be a business you've bought. It's a capital gain on any of those various investment assets, call it. So if they get rid of that discount being 50%, bringing it from 48% down to 24%, you're basically losing half your profits on these gains. So it's going to be less appealing. Most of all, let's talk about negative gearing. Right now, especially you talk about what's going on in Victoria, most of these investment properties are already low yielding, right? If you talk about net yield in particular, right? Yes, we've got investors in Sydney and Melbourne chasing investment properties in places like Brisbane and Perth, to your point, 5 to 6% gross yield you can potentially get in those markets. It's really attractive. Sydney, it's more like maybe 3 to 4, maybe 4 for an apartment or above. But there's a big difference between gross and net, right? And if they abolish these gearing benefits, what's the appeal to, and discount benefits, I should say, on the capital gains, what's the appeal to investors?
Well, the reality of it is there isn't.
There isn't.
And so what you actually do is you're going to reduce supply because all of a sudden tenants are going to have nothing to choose from.
And what do we have right now? A housing crisis.
Yeah. So, long story short, I don't think either of us are trying to be the Prime Minister. But what's very clear is that actual understanding of economics is a basic thing. So I have a look at it and I just use your chart and I go, okay, great. So, and I think I take $1 million and the servicing cost was like circa $3,000, and then now the servicing cost is circa $6,000. And when you have a quick look at that, it's not quite that, but the difference was like 2,400 and 24 over 3,600 was like an increase of like 66%. So on average, it's like a 70% increase in mortgage costs. Now, if rents have gone up 10 or 20, but all of a sudden my mortgage cost has gone up by 70. Like literally the likelihood of, and there was lots of people that were rushing in to buy properties that were neutrally geared or maybe even slightly positively geared when interest rates were at their record low. Now that record low is the lowest I've ever seen it on charting. Now if you go and have a quick look at that, and then you go and have a look at it, we've now got the highest amount of cost of money in the course of the last 13 years. I think it was circa 2011 where we kind of saw interest rates at a similar number.
Yeah, exactly right.
And so from that point of view, that's a 70% increase there. But what a lot of people haven't realised is that there's been a substantial decrease in how much I can go and borrow. Now, I'm seeing numbers circa around about 40% less money. So if Josh could go and borrow $1 million, literally when it was at its lowest point, now I'm actually in a position that I can maybe only borrow sort of 600, 650.
Yeah, 47% to be exact, yeah.
So I like this same income, same assets, very different borrowing power. And I feel like I'm on a TV ad. Yeah. Like that's a part of that.
Well, that, okay, we've been talking about it in doom and gloom in markets like Melbourne, and we maybe sound like we're conspiracy theorists, but now on a positive note, that's the opportunity, in my opinion, right? So
of course it is.
It's a bit soft out there because, back to my initial sort of update on the finance update as a whole, we've had high interest rates now for a year, which are hurting households. It does affect people's affordability on purchasing a property. Whether you can actually get the loan approved or not is a separate thing to actually households being able to afford what they need to spend on interest repayments. And let's face it, yes, everybody knows that interest rates are going to come down. I've never seen consumers, once again, be so reactive to the media and forecasts that keep coming out every 2 weeks with polar opposite views on the forecast of interest rates.
It feels very clickbait. So, clickbait. So this is my read on the play. So the first conversation is that literally, how does it actually work? Now, my basic understanding of the economy and the way I explain it to people is I go, okay, the first thing is you got the RBA, so the Reserve Bank of Australia, and they got to set something called the cash rate or the OCR. And that's running at like circa 4.35. On top of that, the bank's out of margin. So I think that margin usually sits around circa 2%. So let's go and call that 6.35. And obviously that's very dependent upon how much I'm borrowing, where I'm buying, what sort of assets I've got, repayment history, financial health, whether or not I'm married, have kids, all of those risk profiles that will go into that. So we'll be offered different rates, like what you will get versus what I'll get on a home loan could be very different, because of those different things. So let's call it 6.35. On top of that, we then have APRA, the Australian Prudential Regulatory Authority, which then go to add the buffer. And the buffer is sitting at circa, say, 3%. So that basically means, call it 9.35 to circa 10% is what they're actually assessing on my ability to repay. Now, that was built, I think, in and around what had happened with the GFC to really make sure there was a safe, protective environment in Australia. So what happened there didn't happen. And Australians are very prudent, in terms of our approach. Now, what was the lowest the cash rate got to? Do you remember that?
0.1.
Yeah, so that's like 0.1. On top of that, 2%, that's like 2.1. And at that time, the buffer rate was at 2.5. So I'm actually in a position that we're sort of circa...
Well, they put a floor on it, so call it a 5% assessment rate.
So if you say that literally 5 versus now 9.35, that's why there's a difference in the borrowing capacity. So So what I'm going to say to people, I actually don't think that interest rates will be the first sign of relief in Australia.
So what I was touching on is that everybody's so acute to to interest rates coming down, and people are reacting. And 1 minute the market's going hot again when there's forecast that rates are coming down 3 times before the year end, and the next minute it's quiet because some economist says there's another 3 rate rises to come. And, people can't really keep up. But one thing's for sure, we're only going to have a handful of rate cuts over the next year or so.
Sure.
And when I say a handful, maybe 2 to 3, maybe 4 of 0.25% increments, right?
So what's your greatest forward indicator to know that?
Where they say rates should be is probably about 1.5%, let's say, maybe 1% below where we are today.
So I watch the CBA. And I look at them and I look at NAB as the majors in Australia, right? And one of the key things that's happened is they've changed the fixed term deposit.
Yep.
So let's say your great uncle, unfortunately, has passed, $50,000 comes in, you guys don't need it immediately, so you're going to go and put it into a term deposit account for 12 months.
Mm-hmm.
And they're now paying you 0.8% less on that money.
Mm-hmm.
Now, the bank's like, well, we don't want to be paying overs if we're going to be able to get it cheaper from the RBA. So off the back of that, we're just going to reduce. And so what I'm actually seeing, and I'm saying this to people in the room, have interest rates in Australia been reduced? A lot of people go, no. I said, well, they actually have, because we've seen a 0.25% reduction with all the majors in their new variable for new customers, variable home loan rates, because they want to try to be more attractive. Now, that then combined, I'm saying maybe an extra 0.5% in reduction of interest rates over the course of the next 12 months.
Yeah.
When I go to your chart and have a quick look on $1 million property, 0.5% is equal to about $300-ish per month. Divide that by 4, we're talking $80 a week.
So let's slow down there. Let's call it maybe a 5 to 10% increase in your borrowing capacity to keep it broad.
Yeah.
Right, so it's not going to really change things drastically.
So for every 0.5% reduction, you're talking about a 5% increase in capacity. So if I could now go to the auction rather than $1 million, I can now bid $1,050,000. Now that to me is not moment, and I'm kind of like, chuck in an Iranian oil crisis, chuck in a beef production crisis, chuck in a free trade crisis with what happens with the American election. I reckon that could be eaten up at the petrol bowser in a weekend.
Yeah, 100%.
So the likelihood of extra cash. So what we've got to realise is that this is going to go on for a while, and the weird stuff that had happened in a complete overpricing of assets during the course of COVID, we're now in a position that it's yet to find its level. Now, I'm not talking substantial reductions, but lifestyle-type assets like Palm Beach, Mittagong Bowral, Daylesford, maybe, for example, McLaren Vale in South Australia.
Yeah.
Like any of that sort of stuff is going to be under pressure. Now, having said that, there will be pockets that will absolutely fire. And this is what we're going to call that 1 in 4 transactions in Australia, according to PEXA data, there was no loan on it at all. And this is why you could have 2 properties in the same area, one no stairs on a flat block, one with stairs on a sloping block, and the one that's flat literally sells like wildfire, and the one literally with stairs and on a sloping block can't get a buyer on it. And this is what's actually happening is that welcome to a very patchy economy and what I got to call an overly price-sensitive market. Now, one of the key things, and we'd spoken with Alexander Phillips, who you know very well, and I said, Alex, so tell me about it. He goes, mate, last time that interest rates went down, in his memory, property prices also followed down too. And the reason behind that is that literally consumers don't feel like, oh, this is a good time to get in because they've just been burnt by the experience of increases. So they say, hey, look, let's just be conservative here. Let's hold back. We don't want to get into too much debt. There's a big conversation that it could be very much like the 1970s where the moment it goes down, if we go, woo, like that, then all of a sudden, guess what? It goes back up again. And this is a big problem because like 70% of all jobs in Australia this year are government jobs. So the private sector's not hiring. The private sector's in serious trouble. So from that point of view, the government is masking it by huge expansionary, inflationary policies, infrastructure, which is causing lots of problems.
Which is another hot topic. People say the federal government and their initiatives on government spending are inflationary, right? Yeah.
And then
so,
Australia's...
You've covered a lot of things there, right? So let's
break it down.
Break it down. So firstly, let's go back to what you initially said. Yes, we are seeing the banks are speaking loud and clear, you could say, on a few indicators that show where rates are going to be for the next 2 years. So you've got term deposits. They've reduced the rates on term deposits, but not by a huge amount.
0.8, right?
Yeah, 0.8. And same as fixed rates on home loan products, 5.3 with some banks for 2 years.
Sure.
So it is a relief, don't get me wrong. It is going to help. It is going to increase borrowing capacities, like we said. But it's not going to really make the the average homeowner all of a sudden have a lot more money to spend on the front line. In saying that, I want to also highlight that in 2022, we saw when rates started going up, I think it was May, they started going up. That is when the market actually had some downward pressure and prices came backwards for the last 6 months of that year, right? In 2023 going to 2024 especially, when rates were at the peak, the market ran. So we can't sometimes use these indicators to directly correlate what's going to happen in the market.
Sure, people were buying because it's like literally you make money probably in two ways, right? So capital gain is one, and then the alternative view is then rental return, and a lot of people like a good mixture of both. But when you've got a conversation around immigration, then it's like, okay, great. If there's record numbers of people coming to Australia, and if Melbourne's going to be the largest city, why aren't prices increasing? And well, there's some things on that. If you're moving to Australia, number one, I think that the banks probably want you to have a job here for a minimum of 2 years before they would look at you. And so literally, does that mean that in 2 years' time, more of those people...
Well, no, if you speak to a good brokerage or financial, you can still get a loan. But we can talk about that as a separate note. There's something you're referring to there, which I don't think our listeners are quite across. So most of the news you've seen online for the past year or so has been about how prices are going crazy. However, the last quarter it has not been the same. Can we touch on that?
Sure, and I think that there's a lot of reason behind that. You've got a large number of properties all of a sudden coming to market.
But let's summarise what's actually going on. We're seeing prices come off in the last quarter.
Oh, without a doubt.
In most markets,
so
right?
You go up to Palm Beach, like you're talking $900,000 off. And that's a lot. So that $4.5 million asset's now 3.6.
So that's what you're saying the average is 4.5. It was 5.5. Call it down to 4.5. Yeah.
And the reason behind that is why lifestyle asset. But you're not commuting for your daily from there.
We've seen backward growth in most major cities.
Yeah, Melbourne in particular is the really big one. Brisbane Perth is out of control. Perth is like 24-25%. But what you got to realise, like the annual, if you have a look at the decade, I think that like Sydney house prices went up circa 90, Sydney unit prices have gone up circa 40%. It's the best market in the country over the last 10 years in terms of performance. Perth was like only 56%. So Perth actually went through a very negative decline for like 15 years straight. And so what a lot of people don't realise, Perth is just catching up. And to get back to the point where it should have probably been as a conservative market. Now, what you've got to realise is that literally Melbourne is the one that literally has taken the biggest declines. Adelaide's like 15%, Brisbane's like 15%, Sydney's like 6%. So from that point of view, that's across a broader base.
Well, can I add my personal input to all that? Although the various cities and what's going on as well, something has changed since COVID. Is interstate migration whilst keeping your current occupation. Right? So I believe that's a big reason why you're seeing a lot of people leave Melbourne, go to the Gold Coast. Gold Coast and Brisbane is going crazy because lockdown and COVID years down in Melbourne was a nightmare. It was disastrous. And a lot of people now can pack their bags and go move to another city and still keep the same job.
So the thing I'd also say is that arthritis doesn't exist in warmer weather.
As well, yeah.
So what you've got to realise is that there's trends within trends, and the reality of it is that literally when I go and I talk about the headlines, so 70% increase in mortgage servicing costs, only a 10% increase maybe in rents, a 40% decrease in borrowing capacity, as a part of that conversation. We're in a position right now that we're talking about interest rate relief of possibly $80 a week. So this is not going to make a market run.
No.
So what we need substantial proper conversations. Now, if you have a look in Dubai, for example, that market's running seriously hot. They go to call it nervous money. Every single time that there's an unfortunate event of another bomb that goes off somewhere else in the world, they actually get another 50 buyer inquiries. And so what's actually happening there is out of this world. But what Dubai is doing really well is they actually have a plan for the country into 2040. And Australia's not yet mature enough to actually have a conversation about policy on how big the country is going to look by 2040, and we're not building infrastructure. We're the sort of country that lets in 500,000 people and then goes, well, where will they all live? Whereas in Dubai, they're talking about population growth of another 5 million to go from 3 to 8 million people over the course of the next 15 years. Now, regardless of whether or not that's the right thing or not, what Australia does need is it needs a very clear vision of where it's going to go, and you need to build infrastructure well before you get there. And you've got to fund that somehow. And
the key focus on infrastructure, that does correlate to markets of growth. Let's talk about that as an opportunity. So a lot of people are saying that the infrastructure spend in Brisbane and Gold Coast is making certain markets along the corridors of infrastructure, just like Sydney, where the metro is. Follow that metro line where it's going, and it is where all markets are thriving. Just on my point, just to recap what I mean by since COVID, things have changed and people are moving into state. Not only, it's not just because they're going up there to heal arthritis and whatnot and be in the sunshine after a cold winter in Melbourne through COVID. It's also just for affordability reasons. You go back to Perth, like in the past, markets like Perth were thriving because of the mining booms and whatnot. But now, someone in Sydney is looking, well, I could go pack my bags, have the same occupation over there, and I could buy a house for $600,000-700,000.
Exactly.
Here, I can't even get a one-bedroom apartment in Sydney for that.
Car space. I think there was a car space in Bondi for like $1 million.
Oh, yeah. On Knott's Avenue, I saw that one.
I thought you might have been quiet on that. Going for your nice little swim down at icebergs, right?
Now, you touched on something else. Well, I don't know if you touched on it, but geopolitical issues globally have never been greater as well, right? We're like on the
precipice of a change of world free trade.
Yeah.
So it's like 60 years. And no matter who wins the election, I believe that both have a policy about tariffs, and both are in a position that they're saying, hey, we're a little bit worried, and so we're going to put up some tariffs and we're going to move to onshore production, as opposed to, for example, outsourcing production to somewhere. Now, this is interesting. I think that Apple, for example, were exclusively producing in China. Now they're saying we want to be in China, we want to be in India, we want to be in Austin, we want to potentially even have a production facility somewhere else. And the reason for that is that ultimately we learn about the Suez Canal and the issues that brought. But what they're saying is potentially anywhere between a 10 to 30% increase in tariffs on goods, particularly coming from China. And Australian rhetoric is, and I'm not sure whether or not you read the papers, hey, don't buy a Chinese EV because the Chinese government could turn your EV off midway as you're crossing the Harbour Bridge. Now, that's all fear, but what it basically is literally when China's all of a sudden loses one of its largest markets in America, what's it going to do? Well, it needs to flood goods and services elsewhere, and Team U type products end up being options for you, and that then causes issues for Australian production. So whether or not it's right or it's wrong, what you need to be aware of is that there are big political events that are going on that are going to change the nature.
Yeah.
But you know what it gets me to think about? John Combat-Zim, you can't stop the waves, but you can learn to surf. So the best thing that you can do is get really close to your finance broker and say, hey, guys, what are the insights right now? Because I'm using the insights that Shaw is providing me. And when I'm working with an agent, I'm saying, hey, great. So when a seller says, hey, yeah, but you told me that my house was worth $1.4 million in February last year. Well, yeah, have a look at what's actually changed over the course of the last 18 months. So we're now having seen, I'll just give the headline. These are the headwinds that we're actually up against. But where's the opportunity that sits inside of those headwinds? Now, what I'm saying is that this is the best time to be buying if you're a buyer. You are finding exceptional value in most marketplaces. In some of those marketplaces, you're seeing 10, 20, 30% changes. You're seeing some of the best properties that you can buy in the last 18 months. In addition to that, you're actually in a position right now, it's the most safest market to trade up. In the past, if you had said in Sydney, hey, that property's $2 million, by the time you made it to auction day, it would have been like circa 2.5.
So let's just slow down there for a second. But once again, you're covering like 10 topics at once. And I just want to highlight something about, I guess, the word safe in terms of transacting. So, you got to look forward when making a decision, right? And what does the forward climate look like in terms of property? Well, interest rates are coming down.
Sure.
Whilst it might only be a small relief, it still should put upward pressure. We've got fundamental issues on supply. Yeah. Right? We've got a housing crisis and record migration. You should assume that long-term, any purchaser that's bought in the next 12 months is looking back going, wow, that was a good time to buy.
Sure. And, the interesting thing is that I saw a thing on the construction cost index, and they're saying it's 41% more expensive than 2021 today. That's not going down.
The other thing I want to highlight...
You can actually buy established resi right now cheaper than you can build.
Yeah, well, that's why they say it's a whole different topic, but same as the commercial office building market. Yeah, there's a big issue. It's had a lot of negative sort of sentiment toward office buildings as an investor. All the institutions are struggling to get people to go back to working from the office, and a lot of big corporates are downsizing in space and whatnot. But they're saying now all the REITs that own the A and B grade, being the near new or brand new office buildings, are actually sitting on amazing assets because they have to have a 40 to 50% increase in rent to build new office buildings because the building costs has now gone up 30 to 40%.
Sure.
So these established, to your point, established buildings, brand new homes, established office buildings, they're assets now that you're going to get in appreciation on the renovation.
So let me ask you a question. When was the last time you walked into a bank?
Oh, geez.
As a consumer? outside of your job role to go meet someone?
Yeah, I think the last time, or even as my job role, we don't, as a business, we don't go in the bank often.
When was the last time you handled cash?
I think I also saw this on the news just this week. It was 35% of branches have closed amongst all the majors the last sort of 2 years.
So National Australia Bank just closed in Balmain.
Yeah.
Gone. So guess what they're now having to do? Larger call centres. So if you've got a facility for larger call centres, and you're probably going to base that in Parramatta as an example rather than CBD Sydney, because then you've got much more, wider population of people that can come to work, right, as opposed to what's happening in the CBD. So the decentralisation of Sydney is actually being led as well as a part of that conversation.
To answer your question, just so you know, I think it was 2 years ago was the last time I went to the branch, and I went and got a travel money card because I thought you could negotiate. In the past, you could negotiate the exchange rate if you go into the branch. Yeah. I learned they got rid of that, so I won't be going to the branch again.
When was the last time you saw a coin?
Yeah, geez.
Because the King's on there now.
Yeah.
All right.
Wow.
And when was the last time you handled a 50?
Do you remember when you used to chuck coins in the toll and crossing the bridge?
Sure. I'm not that old, Theo, but thanks for that. But what I'm trying to get at is that, what you've got to realise is that, outside of government policy and what's happening, if you go down to the beach and if you go down to Bondi, what does the lifesaver do? They give you the conditions of the day: high tide, low tide, temperature of the water, and if there's sharks. Now, I'm not that smart when I go swimming, but the first thing I look at is, are there sharks? And I know not to go in if they're in. What's the best thing for you to do? No matter what business that you're in, read what are the conditions of the day. And when you know what the conditions are, then you then find out where the opportunity sits. And so I'm not negative or paralysed under any circumstances. I just know that right now, the opportunity is not in development sites. The opportunity is not in blocks of land per se. The opportunity is buying respectfully undervalued established residential property. And also it seems to be pointing much more towards principal place of residence as being the last greatest tax haven outside of investment properties right now.
There's too much speculation on what's going to happen with taxes on investment properties, so people are nervous about transacting in the investment space.
Sure.
Let's just also, there's two things there I want to highlight. One, when I was talking about that forward forecast, you could say, in the climate of property for the next few years, there's lots of green lights, you could say. The other green light, the sort of positive signal up ahead, APRA, the banking regulator, has indicated in the past that you highlighted this change in borrowing capacities, right? So 2 years ago when rates were on that floor, call it emergency interest rates, we won't see them that low ever again, I think. On that emergency sort of calculation, they were assessing people at 5%, and that's when they introduced this buffer of 2.5%, right?
Yeah.
On the way down, right? And that buffer now has gone up with rates, and like you said, some borrowers are being assessed at a 9.5% assessment rate. There's an argument to say that it's too excessive. And if rates normalise at that, let's say, 4.5%, 5% rate to the borrower, all up, with that 2% NIM, to your point, margin that the banks charge, then there needs to be a review of assessment guidelines. And APRA agrees, yes, we will review, they've made comments on this, that they will review the assessment guidelines, but they can't do it until the federal government has achieved what they want to achieve with inflation. So that's basically saying once inflation's in that target of 2 to 3%, you probably see lending laws also be loosened, which once again
change of the economy.
Upward pressure on prices.
And APRA don't meet the first Tuesday of every month. They meet when they need to.
Yeah, exactly. Yeah.
And so it's I think it's the 9th Thursday. It's crazy. So from that point of view, what you've got is that you've got an election year next year. And so for a lot of estate agents, that's a really big worry because a lot of people sit on their hands during an election. And this is going to be called the property election because there's a lot of property-based policy. So 1.2 million homes that they're going to build. How's that going for you? Next conversation around what we're going to do with negative gearing, capital gains tax concessions. So you've got all of this stuff that's coming in, rent caps, all of that sort of stuff that's going on. This is the property election. So we've got April, which is going to be Easter, so Good Friday, Easter Monday, Anzac Day, all at the last 2 weeks. Plus my birthday. Then you then head into May, which is most likely, it has to be called by the end of May. It could be in February, who knows, where Albanese might decide to come back and do that. So that literally is going to be May for the election. Call June, sit on your hands month if there's a minority government, because sometimes it can take them time to form a government. And literally, and who would have thought that the Liberals would be in a position that they might be able to form government versus right now there's a possibility that could be a knife edge either way, regardless of your persuasions. So what that goes to tell me is that the last quarter of the financial year, or the second quarter of the calendar year is in significant trouble. So what my best clients are doing is that they're actually launching a ton of property on Boxing Day. For the first opens on the 11th of January, the 18th, the 25th, and then the 1st of February as the major auction date.
So they go live on Boxing Day and first opens mid-Jan.
Yeah, 11th of Jan. Yeah.
We were talking about this earlier. It's a strategy that's happened in the past as well, especially right now. You was touching on the fact that consumers these days, even when you go on a holiday, so that gap between Boxing Day to, let's say, mid-Jan, whilst people might be, like Albanese up at his Copacabana beach house or whatnot, people might be out of town with family, having a summer break. They're still online inquiring.
So life has changed because when you go away with your beautiful wife, no doubt you take your mobile phone with you. And in the hotels that you go to, no doubt they probably try to access you on WhatsApp if you want to, book in for a dinner or book a massage or do any of those types of things. So although we physically change location, we actually don't. We still live in the same digital world. And so this is a problem. And so people are absolutely addicted. And the data is amazing when you go and have a look at the portals that some of the most searched days on the internet are Boxing Day and New Year's Day. And because everything's closed in inverted commas. And so all of a sudden people are like looking around at stuff. And so we bank all of that inquiry. I would be as aggressive to say that we could see 3, maybe 4 times the number of buyers at an open for inspection in January than an open for inspection in December. All the new listings are coming in January. All the leftover properties that are still not sold are still around in December. And so we don't see a lot of new properties all of a sudden hitting the market in Sydney or in anywhere else in the country.
It's funny. I actually had a bit of an argument with my wife recently about this point about being on a holiday and getting off your phone.
Sure. Yeah.
Who won? I was definitely in the wrong. I was on my phone, poolside or on the beach, sorry.
Yes.
And there was a bunch of people also sitting on the beach, and I made a point of looking around and saying, hang on a minute. No one here is on the beach reading a book anymore. No one's because we went away for the long weekend. No one's poolside with their Kindle or their novel having a read. Everyone is on their devices, searching, Googling, playing on social media, whatever they might be doing. And you're right, a holiday, you're glued to your phone. Probably some might argue you might be on your phone more so than a working week.
Agreed. So one of the things that there's an old school thing, and do you remember the story of two wolves? And it's this old Mexican, and the story. This is basically this old idea where there's this Cherokee, and he's teaching his grandson about life. And he says to the grandson, in your mind, there are two wolves, and it's inside of everyone. And one is a bad wolf. It's like literally, it's all about inferiority, insecurity, doubt, all of those things that go on. And the second wolf is literally about hope and humility and love and creativity. And literally the grandson ponders for a moment and then turns to the Cherokee and he says, which wolf wins the fight? And the Cherokee simply replies, the wolf you feed. So when I think about social media and its interactions and the digital world, sure, there are some good things that I can find out, but on average, it probably feeds a lot more insecurity, doubt, fear. And the challenge is that, you might be away and then all of a sudden your wife's looking and she can find someone else who's got a partner who's maybe potentially got better abs. And then off the back of that, you can be on holiday, but someone else is at a better holiday than you. And so what's actually happening now is we're getting into this position where, play your own game, understand your own strategy and get very, very clear and get really good advice and guidance, which is why I come to you for that, where I just say, hey, look, the advice and the guidance is right now. The opportunity is probably in principal place of residence.
Yeah, I wanted to circle back to this market ahead.
The opportunity is probably having a conversation with your lender to see whether or not they, not necessarily on the refi because that's slowing down, but wait, what would you lend me now? Because that might change your capacity in this next phase.
Because in the next 6 months, if we don't see a rate cut till March, potentially next year.
Albanese is hoping for that before the election. But what I can definitely tell you is that the forward indicator for me, I'm watching the CEO of CBA as an example because there's a lot of money in Australia that's there. And he came out recently and said all the savings that we had during COVID, gone.
Yeah, we've depleted all the offset savings.
So we don't have any of that anymore. And so we're now actually in a position that literally we're on a very dangerous edge. And from that perspective, what you've got to realise is that there are going to be more consumers that are going to hurt. You'll see a rush of properties come to market. We're seeing it right now as we record today's podcast, where people are like, we need to sell before Christmas. And there's a record number of properties that will be withdrawn and or expiring over the course of the next couple of weeks.
So let's talk about a few things. So the next 6 months, opportunistic buying because rates are still high, affordability is low, and naturally people are going to have an increased buying capacity as rates come down. we're also seeing seasonality. Personally, we're seeing that general trends that would be apparent historically aren't there anymore.
Sure.
So we saw a flux of auctions in the middle of winter this year, in July. We saw a record high amount of sales and transactions in the quietest months of the year. The last 2 years, that seasonality has also been out the door in terms of going into Christmas, tail end of last year. We had the Gaza war up, then we had rates go up in November, and it was dead that last sort of quarter. Similar things probably going to, a different sort of change in trend is probably going to happen, to your point, over the holiday season. We're probably going to see a lot of volume through Christmas, through the holiday season.
This market, you're going to see a lot more volume. You just won't see the price growth. So Theo's not going to be selling because he's making $100,000. Theo's actually selling because he wants to sell. He wants to get rid of that investment property and now wants to buy a better family home. Or he wants to get rid of that investment property and maybe pay down a bit of debt on another investment property that he's got. So he's changing his debt mix at the moment.
To be honest, you've hit the nail on the head. I am one of the investors that I look at my yield. I'm looking at my gross to net yield on an investment property or two, and I'm thinking, wow, that's not that attractive. And I'm looking at other asset classes and thinking, I'm better off putting my money in different sectors, especially because I can't see anything changing anytime soon.
Sure. So this is the big thing is that, like, what do we always know is that the foundational principle, you buy really good quality residential real estate and you just wait. And then the secret is to, be in a position, never do anything outside of what your financial advisor wants to give you advice about, but be confident in the future.
And so that's why we're seeing a lot of mums and dads, to your point, putting money into the family home. Like you said, it's that last tax-free haven you can basically get now that the federal government's got their hands on your super too. Just going back to that 3 million point, whilst everyone thinks that 3 million is a lot, who has 3 million in super, there's data to show that if it's not indexed and increasing, soon in about 5 to 10 years, it's something like 20 to 30% of Australians will be in that category. But on the primary residence tax-free haven, something else that we're seeing is a big difference between renovated and unrenovated homes. And I think because in the last 2 years we're seeing a huge increase, a huge increase in construction costs. I think the building industry, the building industry had the highest amount of businesses file for administration were insolvent, biggest sector out of any sector across the country, record amounts. That has naturally made people go, well, I don't want to buy a home that I need to renovate.
Well, there's a couple of things on that too, is that like literally in some council areas, people have been waiting up to 18 months to get council approval. So that's holding cost. Right, and that's a substantial change. So a lot of people who bought a property, a block of land, I'm going to build a house, this is going to be great. They're only just getting out of council now, and they're coming back to you going, so that loan for the $1 million build, how's that going? And you're like, oh, sorry, your serviceability is not there.
Now you can't actually get that one approved.
So I can help you build the garage.
So let's talk about, let's just summarise those 4 points. You've had building costs go through the roof. You've had councils take record amounts of time to get things approved. You've had builders going broke left, right and centre. And what was that last one? Borrowing capacities
has changed
in that period.
Can I add a fifth? They reckon that literally for the government to be able to build these 1.2 million homes, we need an extra 80,000 labourers in construction.
Well, that was the focus of the migration, right? They were really focused on bringing in some skilled workers in those categories.
So what we're going to do is we're going to stop 200,000 international students coming to Australia when education is one of our largest exports.
Yeah. I love the word education being an export. It's a funny concept, isn't it?
But like, it's true. So you go down to Melbourne, and there's a crazy stat, like circa 40% of the CBD buildings are owned by the universities, which are also educational institutions, so there's no tax on any of that. So they get a few benefits. What I'm trying to say to you is that, like, literally, it's bizarre that there's no real clarity about what we're trying to do to build a better Australia.
So let's go back to this renovation issue, because once again, we're sounding doom and gloom, but I actually see that as an opportunity.
Right? Without a doubt, yeah.
So, like I touched on, the disparity between the renovated house and the unrenovated house, just to speak a bit more clearly there, is chalk and cheese at the moment. It's never been greater. So,
but it's also a society that doesn't want to wait.
They don't want to wait.
So society's been bred to get it now.
The sparkly brand new home is going for strong prices in most markets. Despite what I said about households feeling the pressure, there's still some markets, especially eastern suburbs above $10 million, getting record prices, going crazy, especially for the brand new homes. But the ugly duckling, the one that needs a bit of work, and here's the key. what I would touch on before, we were talking about DAs and construction costs and builders and whatnot going broke. They're the things that would be a big issue if you're doing a major renovation, right? If you're thinking about actually doing a DA and having to move walls and put in a pool. However, we find there's great opportunity in just the unloved property that doesn't need a major renovation. Yeah, fresh coat of paint, new kitchen, some joinery. You know, you don't need to move walls. The house and the bones and the fundamentals of the house, the floor plan, it's great. It just doesn't look as pretty and sparkly as the brand new one built up the road. That's the opportunity, in my opinion, at the moment. They're the ones going for good value. Don't underestimate, though, sometimes a cosmetic renovation can still cost a bit, especially if you are talking joinery for kitchen and bathrooms and whatnot. But yeah, across the board, that's just the general consensus. What do you say?
Yeah, without a doubt. And I also think that too, that because of the great repricing of assets, regional is a very different environment to city again. And that's, whereas that had gone reverse, where regional was absolutely firing. But now all of a sudden, the only people that are buying in regional are locals. And outside of that, there are some trends where the bigger corporates are now saying we have to be back at the office. And so there's a reverse of those trends. And so that's why markets like Daylesford are in serious trouble, because lots of people thought they were just going to work from home on Zoom, and now they're being called back to the office.
Yeah, let's highlight that again, because it contradicts what I just said. So if you are thinking about moving interstate for affordability reasons with that occupation that you might be able to pack your bags and move, do it sooner rather than later, because it might not be around for long, because corporates are saying in 2 to 3 years they reckon it will be a 5-day-a-week working from the office mentality again. They're saying that...
Which doesn't stop you doing like a WeWork type situation for Shore Financial on the Gold Coast.
Yeah, you can still do something, but they're saying, well, I don't mind the idea of this. I might be shot for saying so, but I do think collaboration and performance and productivity, the key thing, productivity, the one that the government want to drive, will improve with people coming back to the office. And they're saying, corporates are highlighting that bonuses, promotions, projects, pay rises, all those type of things will be reserved for the people that are working from the office 5 days a week.
Yeah, I don't doubt that.
Which is a good thing. Once again, productivity, they say, is one of the biggest solutions to
that's what they're saying. The biggest inflationary impact in Australia is going to be getting productivity in the workforce back.
Well, just one more thing to touch on. I feel like we've danced all over the place here. We haven't really gone through our agenda, but we never really do. It's fine. I like these free-flowing conversations with you, Josh. It's fantastic.
But it gets you to think that, though. Like, literally, so Theo, tell me what's on the forecast, and then I'll know how to act. And if I know that literally, that right now, that there's a bit of policy movements, the moment there's a change on that Victorian government policy, that's the time to buy. So have your pre-approval ready and wait for the policy change. Outside of that, do something on your principal place of residence.
So something more just for humour, I guess you could say, because it still has effects here. But we touched on the Australian federal election, but the Hollywood one's the more interesting one, right?
Yeah, sure.
The US federal election is going to be before then. That's coming up next month. Which way do you reckon that's going to go, and what effects potentially do you see that happening in our marketplace?
Well, the bizarre thing about it is that, like, it's amazing you can have a population of that size and that's your choice. And I think that more
so true. Well, the choice improved a little bit from 3 months ago.
But more broadly, Western society's in trouble because democracy is not what democracy used to be. And now we're starting to see a lot of changes on that.
Yeah.
Which and you know, I would say that I'm a capitalist and I'm a free market guy. I always have been. I really believe in free market being able to do it. But when you go and have a look at what's happening in the Middle East, some of the development that's going on there is because they want to have government. They want government with private enterprise, and they want a really successful private enterprise. And they have a very simple philosophy that if it's good for business, it's good for Dubai. And I'm not sure that that's the same case in America, and certainly not domestically either. So from that point of view, what I know is that come the 8th of November, when there's a choice, I'll tell you on the 9th how we play the game. Yeah, but they reckon it's like 600 people that will decide that election.
Yeah.
Out of 300 million.
Yeah. It's crazy. I have to say, I've been to America quite often the last couple of years because my wife has a business there, and it's never been more divided.
Sure.
And when I say divided, everybody knows politically they're divided, but they're politically, racially, religiously, financially. It's just divided in every way, socially.
So, but again, that's a social construct that's changed. because of mobile phones and social media. And literally, I don't think most Western countries are actually able to have sensible debate. And so that's a problem, because if you don't agree with me, then you're X, Y, or Z. But if you do agree with me, then you're a good person. Whereas opposed to, well, no, hang on a second, let's actually take the principle, the purpose of what we're trying to debate here and work out what's actually good for society. You know, society as a whole. Now, I understand my duty to society. I'm in a position that I'm healthy, I'm able, I need to work, I pay my taxes, because there are people in society that aren't able to work, which is fine, and we need to be able to look after those people, which makes a lot of sense. And there's essential infrastructure that we need, roads, all of the above. But when you start to think about it, what the Middle East is saying to us right now is that Theo Chambers personally works January to June for the government. July, August and September you work for operational expenses. November you actually work for your wage. And in December you can have holidays. And that's how the Western world's taxation system is currently working. Now, if you go to the Middle East, zero tax, and company tax is circa 8%.
Yeah, although what's going on in the Middle East right now is a little bit scary for most people to hang up their boots and say, I'm moving over there.
Yeah.
But going back to my also point, sort of separate, but what I was saying earlier, it's amazing with some of these geopolitical issues globally, how markets are still strong and businesses are still thriving. We haven't had oil prices stayed strong.
Sure. But it comes back down to the American term of VUCA. Volatile, uncertain, complex, ambiguous. And that term was coined circa 1982 by the CIA. So when you think about that, is it a volatile world? Absolutely. Every day it can change. Is it an uncertain world? Yeah, you can't bank on anything these days. Is it a complex world? Digital has not made it easier, it's made it harder. Is it an ambiguous world? Have you tried to fill out a loan application? Yeah, so from that point of view, we're just living in a new era. I'm really excited for the future. I'm excited a lot for what can happen in the property world. I'm really excited about the development of new financial products and what it can do to go to help people. The lesson is to literally forecast what's ahead and then be in a position to know how to adapt and be agile, but find the opportunity that sits inside of every marketplace. Every market makes a market. Which market is this market making? That's the best set of questions you can ask the brokers in your business, the sales agents in your business, the people that are in the market right now. So given this is the forecast, what does that mean for you and what do we do next?
Well, that's a good way to probably wrap up this podcast to finish that, whilst we've said that there's been concerning signals in certain markets like Melbourne, there is still, if you are an investor out there looking to buy an investment property, it's still lots of opportunity in other markets. Like I said, we're seeing record amounts of people chase investment properties in Brisbane and Perth, where yields are strong, so there's still plenty of opportunity despite the concerns we've highlighted.
Some people want negative gearing though.
Yeah, some people want negative gearing, and you can get your
well, one of only 16 countries
yield.
in the developed world that actually has it. So whilst it's still in play, get involved. Yeah.
So you don't have to just chase that tax haven, that free capital gains tax haven, we should say, on the primary residence. It's still some good areas of opportunity nationally at the moment. I guess to conclude, also, like I touched on at the start of this podcast, Josh is a international real estate coach. So for all I think we've got about 3,200 real estate partners now in our database, separate to our 40,000 listeners. Whoever's dialed in, if you do have a real estate business, please reach out to Josh. He can do from, one-off sessions to weekly coaching sessions.
Lots of different things. Just make sure you mention you're a friend of Theo's.
Just make sure you get the discount for the friends and family being Theo Chambers from Shore Financial. That's all you got to say on the way in. All right. Well, Josh, thank you so much for coming back on our podcast.
Lovely to be here.
We'll once again revisit things in 12 months, see how both elections panned out, see what happened with all those tax issues we mentioned, and we'll hopefully have a lot more to recap on.
Awesome. Thanks, Theo.
Cheers.
Cheers.